This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. I caught this really cool blog post. It was titled, "A New Kind of Investment Outlook." One of those start the year type outlooks. Now, from these things you typically expect, as we all know, predictions, forecasts. This is what's going to happen over the course of the year. Let me tell you all about it. Well, this piece did not go that way. It talks about no prediction. It talks about analysts getting everything wrong. It outlines how forecasts just don't work. It talks about skill versus luck. And it gets at the root issue, which is what we can really control. And what we can control to some degree is eliminating our mistakes. Now, that's not sexy sounding. That's not the 2015 predictions to follow. Eliminate your mistakes. That generally doesn't get a lot of attention. But that's the key stuff. That's the most important stuff. But you know what? People don't want that. People want confident. They want tidy. Confident is in the beginning of 2014 saying that crude oil is going to go to 150, even if it went the other direction in a big sort of way. So this episode is all about the thinking of investing. The right type of thinking to really analyze what goes on when it comes down to a return. So let me put the disclaimer clearly out there. If you're a day trading guy or gal, and you're really excited about trading some Forex pair, and that's how you get your rocks off, that's how you think you're going to get rich, well, you should stop now. I've given the warning. You don't want to be here. I'm not going to be someone on your side. I'm not going to tell you how fabulous this harebrained strategy of day trading currencies is. So you're at the wrong place. Now, however, if you do want to understand how the world really works, my conversation today with Robert Seawright, the Chief Investment and Information Officer for Madison Avenue Securities, which is a boutique broker-dealer and investment advisory firm in San Diego. Bob will give it to you straight. If you don't want straight, I get it. I understand it. There's a lot of people that don't want straight. There's a lot of people that want fantasy, delusion, some type of pathological, something goes wrong in their brain. They just can't handle the truth. Again, I'm giving the disclaimer. Bob and I aren't going to give those types of people, we're not going to give those types of investors what they want today. But for those thinking people out there that would like a little truth, Bob brings some great insights. You know, I caught this article of his. I caught this blog post of Bob's. And it's a great write-up. You have to go read it. And I was like, this can be an entire episode. So I reached out to Bob. I said, hey, let's just have one conversation about this one blog post you wrote about your outlook, your new kind of outlook for 2015. What follows is our conversation about just that. I hope you enjoy. Hey, Bob, Mike Covel, how are you?
Hey, Mike, I am well, thank you.
Appreciate you taking a little time for me today, and I appreciate you coming in a little bit early. I'm calling you from Saigon, so it's it's 10:20 p.m. already here. I hate my West Coast interviews.
Oh, boy. I have not been to Saigon. I would love to go, actually.
You know, it's funny, after doing this from here, or at least from Southeast Asia for the last year and a half, the first year and a half of this podcast, I was in San Diego. But it's amazing in talking to so many different people, many of your peers, it's amazing how many people are intrigued by this place.
Well, I'm of the age where, you know, Saigon was on the evening news every night when I was a kid. Mm. Obviously a really different context, but it's there, you know?
Yeah. Yeah. I'd say in about the last 18 months, guess how many Vietnamese people have asked me about the war? Zero.
Yeah, I was going to say, the fact that you asked the question means either a huge number or zero.
Yeah, it's zero. It's zero. And the country's so young. I mean, 50% of the population, 90 million people, 50% are under the age of 30. They weren't alive. So,
yeah.
Hey, listen, let me jump right in with you. I've only got you for a short while here. Bob, I thought your post on, I believe it was February 6th, a new kind of investment outlook. Wow, there's some density in there. And if you can make headway on getting the investing population to accept what you wrote as truth, you're onto something.
I hope so.
How did you come to put that together? Because for all intents and purposes, you're really telling people you can't predict anything. There is no perfection. Now let's talk about being real. How did you start to put that piece together? You didn't just write that in 5 minutes.
No. Well, there are two separate trains to get me to that direction. I've been writing about those general themes for as long as I've been writing the blog Above the Market, which is about 3.5 years now. But I had not pulled it all together in one place. The second train is every year in my role as Chief Investment Officer of Madison Avenue Securities, I have written an investment outlook. It was always conflicting for me because I wrote some of this stuff, but I also wrote some of the typical investment outlook stuff. Gee, this is what I'm concerned about. These are the sectors that I'm worried about. These are the sectors that I like. These ought to do well. And I had a good track record relative to those picks, if you will. But I was less and less comfortable writing that way because I was convinced, based on the research, that kind of prediction, and I contrast that with the types of investment approaches that can be demonstrated to work and persist, value, small cap, momentum, things like that. I was simply uncomfortable making those typical kinds of predictions. Gee, I love Apple, I hate Apple, I love small caps, I hate small caps. I love European large caps, I just didn't want to go there. Normally, I hunker down from, New Year's for about 2 weeks and write a lengthy outlook, and I had just about finished it, and I said, no, I have to do it differently. And that's when and how I wrote the outlook that went up on the blog in the beginning of February.
Let's talk about perfection prediction. So, clearly there's been Nobel Prizes handed out for this type of psychological work, behavioral work, but this idea that in the investment space, so many people want perfection. It's, for me, and I'm sure you feel the same way, by now it's kind of like I almost want to label that desire for perfection as some type of a condition, not a good kind of condition, a condition where perhaps medical treatment is necessary. At what point in time does perfection get off the drawing table? When does this go away?
I don't know that it ever does. One of the scariest aspects of all of this is our bias blindness. We can readily accept the idea that other people make mistakes. We can even, if we're rational at all, recognize that we make mistakes, but we can't come up with any current examples. So, we're blind to our own biases, and in fact, the fact that we know we're biased doesn't mean we're more likely to see it in ourselves. So it's terrifying. Yet you describe it as perfection. I usually describe it as certainty. We want certainty in the worst way. We are suckers for the next person that comes by who is totally sure of himself or herself and the holy grail they've figured out, whether it's investing or in something else in our lives, we resist randomness at every opportunity.
I think a great example, a great market example for the audience to consider, how many people do you recall in the beginning of 2014 that were talking about a crude oil collapse?
Zero. In fact, I think it was Bloomberg looked at 72 economists, and 72 out of 72 had higher interest rates, lower bond prices, and crude oil at like $95 a barrel. Obviously, 72 out of 72 were totally wrong about all of those things.
It'd be one thing if the move was only down 10 or 20%, you could give someone a break, but the amount of money that's paid out in salaries and fees to the so-called experts to miss something that dropped well over 50% is quite amazing.
All I can do is say, yes, indeed.
Yeah, I mean, it's just, let's talk about experts for a second, because I think we've somehow or another, we all kind of know that you're in California right now, and everyone kind of knows bridges, and even people that don't follow things too closely, bridges in California are built to withstand earthquakes. There's variability. We all kind of know about variability, but somehow or another, in that desire for the buck, for the greenback, for the greed, we want to discount variability. There's no more volatility exists because all we see are the dollar signs.
Well, and partly the problem is in our world, we have claimed that risk is the same as volatility, and I get that because it makes for clean equations for pricing options, right? But the reality is volatility and risk are hardly the same thing. And in fact, volatility is an opportunity for investors. We all recognize that we should buy low and sell high, but everything about our emotions tells us the exact opposite. When I work with advisors, I routinely tell them the markets are about the only place in the world I know of where people don't want to buy stuff when it's on sale. They want to pay full price or a premium.
I noticed that you put in your outlook, you talked about a particular prognosticator that mentioned gold going to a price level of 5,000 and essentially about 80% below that today. I think it's fair enough if somebody wants to be critical of the Federal Reserve, but I think the real mistake with these predictions of gold's going to go, criticizing government policy or criticizing a government institution doesn't necessarily connect to any kind of trading thesis or investment thesis.
One of the great mistakes that gets made over and over in the investment world is investing based upon your political views. That mistake keeps being made over and over. We assume if our political enemy is in office, and because we believe that enemy is bad for the country and that things are going to go south, that therefore the markets will necessarily go south. And none of that stuff is necessarily connected.
Now, on the flip side of that, I think everybody that's observed the markets since the dot-com bubble days can probably say to themselves, wow, U.S. equity markets have run up extensively. Is there the possibility that we could see another S&P 50% correction? And I would say, sure, perhaps, but once again, you can't predict these things.
Exactly right. We all get afraid, and then over time, we get a little less afraid, and it's like the famous frog in the kettle, right? That if you put a frog in a kettle of cool water and put it on the stove and turn on the heat, the frog doesn't notice that he's boiling to death. I don't know if that's actually true, but it's a pretty good story. We get that way about everything, and whether that means we're overly afraid in March of 2009 when the markets are at their bottom, and we wait to invest until it's either we've missed a whole lot of the gain or perhaps back to the top of the market, and then we go all in at the worst possible time. Now, that's exaggerated for most of us, but it's not nearly as exaggerated as we'd like to think.
When you look and you see the media, you see the daily run of market predictions, I sometimes have these conversations with people and they'll say, Mike, don't get worried. It's just entertainment. People just look at that for entertainment. Deep in my gut, even for a Jim Cramer show, I don't think people really watch it for entertainment. I think people watch the financial media, whether it's a little more fun like Jim Cramer's show or some of the more serious stuff. I think people watch it because they think that information is going to give them an edge and they're going to make money with that information. I think to think anything else is a little bit unusual. I mean, do you really think people just look at it for entertainment? I think it's more serious, even if they don't admit it.
I wrote a piece about a year ago called The Great Charade that looks at that exact question, and the great charade of what passes for financial media is that almost all of what they do should be irrelevant to what investors practice. So the right answer to almost every question in the financial media ought to be, I reject the premise of your question, but that's not what happens. Every prognosticator or pundit or wealth manager that shows up on TV answers the same questions everybody else answers, even though they should object to the premise of the question. They answer whether they like Apple or not, and what their price target is, in what time frame, and what, like Jim Cramer, what stocks they like and what stocks they hate. That's terribly dangerous business, and like you, I think far too many people treat it seriously than should. And the charade is that financial television pretends all of that stuff matters and that any of those predictions are meaningful.
Let me just to interject midpoint here. What was your feedback so far? What was it was to go through the piece, very lengthy piece, and very thoughtful, logical, makes perfect sense. Did you get any pushback? Did you get any fight back putting this out?
Very surprisingly little. What's interesting, happily, it got a lot of attention. I heard a lot of good things from people about it. The difficulty is for most people in this business, they find it hard to disagree with because the research is so definitive. It's not like I'm going out on a limb here with what the data says. The problem is it goes against the way most things in this business are marketed. We market based upon the idea that we can predict, we can time, we can routinely and regularly outperform by a lot. All of us are way too eager to believe people who tell us that. And so from a marketing perspective, dealing with reality is really difficult. That's the conundrum people in our business face. If you want to actually help people, if you want to actually be successful at investing, it makes marketing very difficult because it's not what people want to hear. I think the best show on television is The Americans. It's the Soviet era spy drama on FX every Wednesday night. In a recent episode, an FBI agent who's in the counterespionage unit is talking to one of his colleagues, and the colleague had been undercover for 3 years with white supremacists. And the one agent asked the other, what did it take to fool them, to stay undercover and to infiltrate them? I thought the answer was really telling. He said, telling them what they want to hear over and over and over again. And the first agent asks, that's it? the infiltrated agent said, people love hearing how right they are. And I think that's absolutely spot on. We want to be right, and we love to tell each other we're right, and we want to believe either that we're right or that we can point to the people that are right, and that way we can be different and succeed. The marketing of this business contradicts what the research data says, and that's the difficulty we always face.
You know, as you outline in your piece, you need to have a mental structure. You need to have a framework for understanding volatility, variability, et cetera. But once you do that, if you can let go, and I want to kind of quote you from here, you talk about, we all want the high leverage ideas, the ideas that will make the biggest impact on our portfolios and our lives. Clearly something that's just not sitting out there for us to pick up off the sidewalk. But if you can let go of that high leverage idea, it's almost a stress reducer.
That's right. And part of that is the irony of it is the high leverage idea is actually to eliminate the stupid mistakes that we all want to make, to be much less stressed. There's a great deal of research to suggest, most prominently by Terry O'Dean at Berkeley, that suggests that the more we trade, the worse we do. And that's true of professionals as well as do-it-yourselfers. It makes tremendous sense not to be obsessing about this stuff and panicking about this stuff all the time. I have discipline in my own life. I don't look at my statements, but twice a year. Even, that's not quite fair because I'm dealing with and watching the markets all the time as part of my job, so I know generally how things are doing. But I carefully discipline myself not to look at my statements, because looking at my statements gets me thinking in terms of acting more often than I should act. It's way less stress-reducing not to have my portfolio up in the corner of my screen and watching it tick up or down based on, in lots of cases, temporary nonsense.
Thank you for giving Terry a shout out. He will be on my show soon. I look forward to chatting with him. Very, very bright guy.
He's terrific.
Yeah. There was a great example that you gave in this write-up that we're talking about, going back in time to Nobel laureate Kenneth Arrow and talking about how he did a tour of duty as a weather forecaster for the U.S. Air Force during World War II. And why don't you relay the story? But essentially, it's almost like the powers that be, some of these things that we're talking about on TV, media, et cetera, they kind of know it's all bogus, but they don't care. And they don't care. There's a reason why they don't care, because there's a lot of money in selling silliness, isn't there?
Oh, there's a tremendous amount of money in selling silliness, as you say. I'll get to the Arrow story in a minute, but Nassim Taleb, who wrote The Black Swan and Fooled by Randomness, tells a story about a trader who listened to a firm economist and made a big trade, and it performed badly, and he got fired. And the trader said to his boss, "What are you firing me for? I was simply trading on the economist's idea." And the boss said, "I'm not firing you for losing money. I'm firing you for listening to the economist." And there's a huge amount of silliness in our industry. It's part of the marketing I mentioned before. The Ken Arrow story, he was subsequently a Nobel laureate, and Jason Zweig tells this story in the Wall Street Journal. I have to give credit to Jason for telling it. He was a weather forecaster. He was ordered to evaluate a variety of mathematical models for predicting the weather 1 month out. I should add, for audience members who have read Nate Silver's terrific book, The Signal and the Noise, we have since gotten a lot better at predicting weather in the near term, out to perhaps 7 days. At the near-term level, probabilistically, we're pretty good, but we're still totally wretched and unable to predict weather out a month. But he was, during World War II, he was ordered to evaluate these, Arrow was ordered to evaluate these models out a month, and he found, consistent with what we still find today, that they were all worthless. So he reported his findings and said, yup, they're worthless. And his superiors came back with another order, and I'm quoting Jason's telling of the story, which I'm going to do by memory now, but it was something on the order of, the commanding general is well aware that the forecasts aren't any good, but he needs them for planning purposes. Now that's funny and ridiculous, but it's also true.
I think sometimes people have a hard time wrapping their arms around the idea that the prophet or the official on TV could possibly, in that nice suit, could possibly be actually, with a smiling face and all the conviction, be pulling the wool over their eyes. It's almost like we can't believe our lying eyes.
That's why I called it the Great Charade, because interestingly, financial television, by and large, the ratings have just gone in the toilet. They are convinced if they don't act as though everything is crucial all the time, even fewer people will turn in. And so the game they play is to try to convince you that they have urgent, crucial market news 24/7. And for the vast majority of people, that couldn't be further from the truth.
I sometimes wonder if something like my little podcast, which has generated millions of listens, I sometimes wonder if it's a result of people saying, I've had enough of the typical, and they just want to listen to pragmatic voices. And so what the programmers on the big media channels might think, well, that's not sexy enough, that's not cool enough. But the reality is that's kind of what people want.
I have often wondered if some smart financial outlet, especially in these days of seemingly gazillions of cable channels, would create something more helpful and more meaningful on a regular television basis. And I'm sure there are some of those things. There are lots of podcasts that do it, whether yours or Barry Ritholtz's Masters in Business, or a number of them that are out there that I like to listen to and find really helpful and interesting, but they're not nearly as sexy, at least in the short term.
There's as we wind down, there's a big picture point that you make, and I think if we can think back to some of the guys that made a lot of money during the most recent bubble crisis, like John Paulson. And you have a story, a little parable story. American virologist David Baltimore also won a Nobel Prize in medicine. And you talk about, we all like to imagine that there's these Michael Jordans out there in the investing world. Even not more so Michael Jordan, but there's these lone wolves that have really figured it all out by themselves, and they're so secretive, and no one knows what they're doing, and they're doing something so original and so unique versus anybody else, and nobody else could possibly understand it. And that pitch and that story still sells, doesn't it?
It does. David Baltimore won the Nobel Prize in medicine in, I think it was 1975. He worked on the genetic mechanisms of viruses. Later, he was the president of Caltech, just north of where I am in Pasadena. He said that as the president of Caltech, he got manuscripts all the time from scientists or would-be scientists that had claimed to either come up with a theory of everything or had changed some big scientific paradigm. And he said they were often really smart people, but they had never done what they had purported to do, and it was almost always because they had made one key error back at the beginning. The general point he was making was that good science is always a collaborative community effort where various scientists are pointing out each other's errors and problems and difficulties, making each other both accountable and better. And so the point Dr. Baltimore was making is that good science requires more than one person in accountability, and this is the line I have never forgotten. He said, "Crackpots work alone." I think that's true of all of us. We all work better with accountability. Daniel Kahneman, the Nobel laureate for behavioral finance, talked a lot about adversarial collaboration. He did it most prominently with Gary Klein, where you work with someone you fundamentally disagree with and agree on a set of protocols to try to test the thing you contest about and try to come to some kind of consensus. They had some wonderful success and eliminated almost all of their disagreements through their work together. That's something we would all benefit from. Kahneman talks about the best way to mitigate errors is to get your smartest and least empathetic friends to come over and tell you all the ways you're wrong. And that's actually not bad advice.
You know, I was thinking about the Baltimore example again, and to play devil's advocate back to you, I was thinking of Michael Burry, the Big Short fame. He was on 60 Minutes, and he figured out all the analysis. And I'm sure he is an absolute genius, and I'm not hating in any way, shape, or form. But I think when you look at a situation like that, one has to say, how much luck was involved, and could it be repeated the way he did it, and if luck was involved, and if it can't be repeated, then how is the one shooting star example useful for you if you have an investment horizon of 50 years?
Well, I think there are two ways to deal with that, and Michael Burry was spectacular in that instance, and he was completely right, but so was John Paulson. And John Paulson's hedge fund, Advantage Plus, lost 36% last year when the total return of the S&P was 14 and change. So at least in his case, he wasn't a genius across all categories. He made one fabulous call, was completely right in a very difficult circumstance, one of the very few people who was right, but subsequently has not done so well. There are a few people that have shown incredible success over time in the investment universe. Seth Klarman, unbelievable track record. But Seth Klarman isn't taking your money or mine anymore. And while, there may be a few Seth Klarmans out there, they're all insanely rich and none of them are going to take your money. And while it's easy to prove that the markets are inefficient, it's also crazy difficult consistently to beat the market. For most investors, most of the time, it would make sense not to try to find the next Seth Klarman and simply invest in a way that's going to give yourself the best chance to meet your goals.
My last thought. So if we can get people to move away from the idea of spending all of their waking time trying to locate the next Apple and to so they can then have that curve that looks like Apple, I want you to explain, so we give people something concrete to think about. And you do that. And you say, listen, let's start by systematically eliminating our most obvious mistakes. And so instead of, it's kind of like, hey, cut your losses and let the winners take care of themselves. But you're really saying, don't worry about the upside. Let's be defensive. Let's worry about the downside. Let's get rid of the things that we know we can control, because we can't necessarily control what's going to be the next home run or the next big thing. We can't control that, but there are things that we can control.
Yep. A couple easy examples. We can control costs. The leading indicator of the success or failure of any investment is how much we pay to obtain it. Secondly, we don't consider investments. There are all kinds of studies that show that if a manager has skin in the game, his or her fund is much more likely to perform well. So we want aligned incentives with managers. You want them to have skin in the game. Those are simple, easy examples that everybody can do all the time. It's not nearly as sexy as trying to figure out who's the hot new manager or what's the hot new stock or what's the hot new sector, but it's a lot more likely to make you money over the long haul.
Hey, by the way, it's a lot more fun. I mean, I'm sure it's fun. I was going to say you've talked about giving outlooks before and prior outlooks in prior years, but I'm curious if it's a lot more fun to put together a piece like this, because intellectually it's a lot more interesting and a lot more. I guess the only thing I could say is truthful, honest, is to go through this type of approach and let people see it from start to finish with these various examples from some areas that have nothing to do with the markets and investing.
It is really fun and interesting, and it's also much more real. If you listen carefully to the various analysts with their annual outlook predictions, almost all of them have the honesty to say, treat these with a total grain of salt. Niels Bohr is right. Prediction is really difficult, especially about the future. And they say that, but then they play along with the game and come up with their prediction anyway. Every year I look at, and I've done this for a number of years now, I look at the predictions that the major strategists come up with, and they're almost always badly wrong. This year, for 2014, same thing. The consensus view of the S&P, it was going to be up 6% and change, and it was nearly double that. The folks that try to do that, or that do it officially, almost all recognize that it's a game, and if they treat it as a silly game, it's a little easier to deal with. But I'm with you; it's a lot more fun dealing with reality than with the gaming aspects of it.
So that they still give the predictions, then they give the disclaimer. But while they're giving the prediction and while they're giving the disclaimer, they're winking out of the left side of their eye. So,
absolutely right.
Yeah. Hey, Bob, where can we send people? Where's the best place they can go to check your blog out and read you daily, weekly? Where can we send them?
rpseawright.com, rpseawright.com. The blog is above the market. I'm on Twitter too at @rpseawright. I would love for people to read.
I hope we can chat again in the future. I definitely I like where you're going, and keep it up.
Thank you, Mike. I've enjoyed your podcast for a long time, and I'm happy to be included. Thank you very much.
Appreciate it. Thanks, sir. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.